28th August, India's central government failed to raise money from bond market. The reason being its banker, the Reserve Bank of India, rejected all the bids it got for its auction, citing that the borrowing cost was very high. Bond investors were surprised and were not very happy because they believed that amidst rising inflation, the economic uncertainty, and the heavy borrowing of 12 trillion rupees this year, the government should pay more. RBI since then has rejected 3 more auctions. This clearly explains the relationship between the bond market and RBI can sometimes turn combative. In this video, I try to explain why the yields are at decadal low in spite of all the odds that the country is facing. There are a set of broader underlying economic questions behind these moves. While the answers are aplenty, all of them point to one direction: pricing. Amid a raging pandemic, the central governments across the globe are borrowing more to spend and boost the economy. Being one of the worst hit economies, India therefore has the right to borrow and spend. Therefore, the government expects the rates to be lower and not to be punished for the borrowing. Mr. Das, our RBI governor, is therefore justified to expect the markets to offer India lower interest rates. In this pricing tussle, RBI seems to be winning, but this couldn't have happened without them being themselves a big dominant player and intervening in all yield curve points. Therefore, this points out to another important question of RBI becoming a dominant player and why yields matter. The sovereign bond yield curve is the biggest reference point for most of the financial instruments in the economy. Corporate bond yield is nothing but a risk premium added to the government security yield. Businesses compare their return of investments by considering the GSEC yield as their reference point. In essence, the long-term cost of private capital relies heavily on the long-term cost of low-risk government security yield. Therefore, they want the rates to be cheaper so that they can set up factories, build roads, and create jobs easily. The argument for RBI to intervene to keep the interest rate lower is stronger than ever in this financial year because this year is expected to be a recession year. Low bond yields are a huge motivation, but intervention by RBI is neither simple nor the outcomes binary. There are always going to be trade-offs and downsides. While low bond yields might benefit the borrowers, it hurts the investors at the same time. The interest rates on public provident fund and many other retirement saving instruments are linked to the same GSEC yield. India has got a lot of savers and they are currently hit because of low interest rates and high inflation. For the real interest rates to turn positive, the inflation has to come down. Currently, the long-term GSEC yield are suppressed because of RBI's intervention and newer things like Operation Twist and rejection of auction bids. In essence, the current GSEC yield doesn't reflect the real picture of inflation, and the inflation rate can severely climb up the moment RBI takes off its accommodative stance. Low interest rates in the past have severely affected inflation, especially when it is targeted towards consumption. So now the shift of money to risky assets like equity and gold is a given. There is no doubt why equity market is at a high across the globe because the interest rates are lower. By keeping or promising to keep the interest rates lower, RBI is forgetting the long-term consequences and may have severe medium-term inflation impact. The bigger question is, where will you invest today? Write to us.